Welcome to Flipping the Orthodoxy, a development reimagined fictional series that demystifies Africa's economic story. Episode 2 follows 3 African negotiators as they renegotiate Africa's resource-based contracts, clearly, fairly, and on African terms.
Tomorrow we sit down to renegotiate 3 legacy deals. Quick clarity: renegotiation isn't default, and it isn't begging. It's a normal business step. When facts change, you update terms so the project still works for both sides. For us, that means fair prices, realistic timelines, and lower risk.
And loan contracts here aren't just government-to-government loans. We're talking project finance for ports and power plants, resource-backed loans tied to commodities, and public-private partnerships. Different shapes, same principle. If the world moves, our contracts should too.
On sovereign loan terms, we anchor our ask in Africa's common position on debt, push for low interest and long maturities with grace periods so debt service stays bearable. Concretely, we target single-digit, ideally concessional rates, maturities stretching decades, and 5 to 10-year grace, reflecting the AU stance that historically called for 50-year maturities, 10-year grace, and low interest when rescheduling or making new loans. Where concessional windows exist, for example, IDA, we press to restore earlier concessional terms, 10-year grace, 50-year repayment, 0.75% service charge, rather than accept shortened tenors that raise annual debt service. Our pitch is simple: modern clauses that protect the public and give investors certainty. Let's walk through the key terms with plain language anchors.
Take the iron ore contract signed a decade ago. Back then, the price was modest. Today, it's nearly tripled.
Which means the lender is collecting far more value than either side projected, while our revenue share hasn't budged.
Investors still profit, but citizens do too. Without that, one-sided windfalls undermine both credibility and fairness.
One project shows the principle. Contracts must breathe with the market, not trap us in yesterday's terms. This is about credibility. We're not tearing up contracts, we're modernizing them so they reflect today's reality. Post-shocks, new technologies, climate risks, updated laws.
For loans, modernise means prefer concessional finance, low interest, long maturity, real grace periods, so debt supports growth instead of crowding it out. In practice, that means target single-digit rates. Aim for at least 20 to 30 years on new borrowing, and where restructuring, push toward approximately 50 years maturities with about 10-year grace, consistent with Africa's common position on debt.
Use a debt service to exports anchor in restructurings so annual payments stay reasonable and bearable for the economy, again mirroring the AU position. For minerals, modernise means updating concession-heavy deals toward models that share upside, shorten lock-ins, and keep the state at the table. Joint venture equity seats, production sharing contract style profit splits, published terms, and scheduled reviews.
It also a great de-risks for investors. Clear formulas, predictable reviews, transparent numbers, less politics, more delivery.
And it keeps the value here. When projects do well, citizens do well as the investors. By design, not by luck.
Which brings us to profit-linked returns. The idea is simple. When projects beat expectations, the public shares in that success.
We'll propose profit-linked royalty, a small slice of revenue, money in before costs, so government income is steady. Windfall trigger: if profits or prices jump far above the base case, our share steps up automatically. Escalator: the ladder that spells out those step-ups, say at 25% and 50% above plan. Ring fencing: costs stay inside each project so no one shifts losses from Project B onto Project A.
In everyday terms, if the project does unusually well, the public sees some of that upside without another round of negotiations.
For extractive-linked contracts specifically, let's move beyond rigid, decades-long concession models that lock in low public share and little flexibility. We'll propose alternatives used globally: joint ventures with public equity seats, production sharing contracts, state retains resource ownership plus profit split, and carried interest options plus caps on lease duration and time-limited stabilization. We'll also commit to publishing key fiscal terms and reviewing them on a schedule. These steps keep governments as active economic actors, not passive landlords, and align with current calls to redefine terms with global mining houses. Numbers only matter if we can see them. Independent audit. A neutral accountant checks the books each year. Standard definitions: profit, cost, revenue, no fuzzy labels. Public reporting. A short yearly dashboard so citizens know what the deal delivered.
Transparency lowers investor risk too. Fewer surprises, fewer disputes.
Today, most contracts send disputes to distant courts or tribunals. We'll propose African-seated arbitration using respected regional centers with at least one African arbitrator on the panel. Cost goes down, context goes up.
And before anyone lawyers up, we add a good faith negotiation window, 90 days with clear steps, project team, joint committee, ministers. The idea is to fix it early when we can.
Where it fits, we can reference the African Continental Free Trade Area AFCFTA rules for cross-border commercial issues.
Incentives can attract investment, but blank checks drain revenue.
So, sunset clause. Any tax holiday ends automatically after, say, 5 years. Most favored taxpayer clause, MFN. No hidden sweeter deal for someone else. If a better tax term exists, it's public and it applies equally. Thin capitalization limits. Caps on how much debt an investor can load onto a local project to shrink taxes. Transfer pricing rules. Standard methods to price sales between a company's affiliates so profits aren't shifted offshore.
Plain version. Incentives start narrow to grow based on transparency, then expire unless the investor proves real local value. Jobs, training, tech transfer.
No more 50 to 99-year lock-ins. Term, 15 to 25 years, matched to asset life. 5-year review. A structured check-in with a scorecard. Uptime, jobs, local spend, emissions. So we course correct without reopening the whole deal.
To manage volatility, we add price band resets. If revenues or commodity prices drift too far from the base case for 2 straight years, the fiscal terms glide back toward balance automatically.
Think of it like suspension on a road. Bumps happen, the car shouldn't brake.
We'll set measurable local procurement targets, apprenticeship numbers, and skills transfer milestones with annual reporting.
On the ground, that means local firms get a fair shot and young engineers get real training. People feel benefits now, not only in year 20.
Environmental and social safeguards are aligned to our national law. Miss them, and there's a corrective action plan and then penalties if ignored.
Investors ask for stabilization so sudden legal changes don't sink a project.
We'll avoid blanket freeze the law language. Use equilibrium stabilization instead. If a new law has a big financial impact, both sides meet to rebalance. First with non-cash fixes like timeline or reporting changes. Only then financial adjustments, arbitration last.
That respects the right to improve laws while keeping projects bankable.
And in mining, we'll make any stabilization strictly time-bound and tied to transparent performance with lease-length caps, so terms keep pace with market reality, not just legacy concessions.
If things go wrong, citizens still need power and water.
So we define force majeure, a tight list of true shocks, war, natural disasters, not my costs went up. Cure periods, time to fix a breach before penalties. Step-in rights, the state, or a backup operator, can temporarily take over to keep services running. Performance security and decommissioning bonds, money set aside up front so if there's failure or closure, public costs are covered.
In short, protect the service, then sort the money.
That's our brief tomorrow. Profit-linked returns with clear triggers. African-seated dispute resolution. Time-bound incentives with sunsets. Tax integrity rules. Realistic terms with 5-year reviews and price band resets. Local value with community safeguards. And stabilization that balances investor certainty with the public interest.
We borrowed, we negotiated. Now we renegotiate to set the standard, not chase it.
Let's flip the orthodoxy on our terms.
To find out more about Africa's evolving approach to economic and financial reforms, visit our website, developmentreimagined.com, and follow us on social media.